So there's a few issues that you run into with development fairly consistently. Zoning is always something, but you know a lot of that ahead of time. That's just a time delay most of the time because you have to go through zoning with the planning commission and then the supervisor's commission for approvals, and that takes time. One of the biggest issues that you run into there, though, is dealing with neighbors. And neighbors specifically that don't want to see development. For instance, we developed a 60-acre parcel here in Mars, which is actually my family's property. And it was a 2.5-year process to go from initial approvals from the township to actually closing on the deal because the neighbors just didn't want to see development, basically next door to where they live. Even though it raises their property values, we were paying and bringing in all the infrastructure with all the utilities and everything. But sometimes neighbors just don't want that. They don't want to have to worry about looking out at other homes. And so neighbors can always throw a wrench into the mix when it comes to development, separate from all the other issues with zoning and permits. And permits go hand in hand with zoning and approvals and everything like that. So neighbors, honestly, is one of the biggest issues that any developer is going to run into when you're developing a community, a neighborhood in an area that doesn't have that type of stuff on property, on acreage that has been basically not developed for however many years. So that's one of the biggest issues you run into. Yeah, so I think it's a combination of a couple of things. One, like they had 10 acres and then our property was 60 acres. They just didn't want to see 40 houses out their back door when they haven't looked at anything other than, open fields and woods, right? And I get that to a point, but it's also at the same time, it's like development's inevitable, right? Populations are growing. We're 3-4 million homes short still nationwide. So development's inevitable. You can delay it, but you can't stop it from happening. And then, I think the other thing too is with development comes construction. With construction, there's noise and there's, all kinds of, equipment being brought in and moved and earth moving. And so a lot of neighbors don't like that disturbance a lot of times too, right? It's a great question to ask right now, specifically due to the market environment being that interest rates they're up. People are saying they're ridiculously high. They're not. If you look back over the last 30 years, your average 30-year fixed interest rate was between 5.5% and 6%. We're a little over 7% right now for a 30-year fixed. So they are elevated, but from an investment side of things, it really does make a big difference because the more you pay in interest, the less your profit and the cash flow you're going to have. And so you have to look at your acquisitions a lot closer to see what the cash flow is, which coincidentally is why there's been such a big disconnect in the multifamily space, basically since late 21, early 22, when rates started going up. And you had sellers still trying to sell their properties at a very compressed cap rate, 4%, 4.5%, even 5%, like they could when interest rates were at 2.75% or 3%. But now all of a sudden you have interest rates that are 6 and 7 and even 8%. And you have sellers that want to sell a property at 5% cap. It's just the numbers don't work. It won't cash flow. It's what we call negative leverage, right? So interest rates really determine what you can really buy at, the price you can buy at, what cap rate you can buy at. And you never want to be buying a property with your cap rate that's lower than what your interest rate is, because you're just going to be negative cash flow, you have negative leverage, and it just doesn't work well. So those interest rates really help determine that, and that's what we're seeing in the market right now. So local market conditions always play a factor because you got to look at what the population is doing. And in one market it might be stable, in another market, in another state, you might see price declines, you might see population declining. We saw a huge exodus out of a lot of states during COVID, California, New York, even Pennsylvania, to southern states or more red states. And we've talked about this before. We don't really buy in blue states at all. They're not conducive to landlords. The tenant and landlord laws are generally skewed more towards the tenant, and which makes it hard if we have a tenant that doesn't pay to get them to pay or get them out of the property. And so market conditions play a big factor. With market conditions, though, you also have to look at price points. Price points tend to increase when you have an influx of population because you have a higher demand. So Those are all things that come into play when we're looking and identifying properties that we want to buy and where we want to buy them as well. We like to see growing populations. We like to see that being steady, not just a big surge in one year. We like to see that, you know, a general or a gradual increase over a longer period of time in markets that we're looking to buy in, because that means it's a more stable market, and it's just gradually increasing versus a huge spike and then drop back down. Well, so negative leverage in general, 9 times out of 10, the property's not going to cash flow. And if the property's not cash flowing, you're not making any money, right? And if you can't value add to that property, meaning you can't come in and renovate the units, increase rents to market average to drive cash flow up, then you have to rely on a price appreciation on the property itself and rent appreciation year over year. And that's a very long-term play. That's a 10, 12, 15-year play. And if you're upside down and you're not cash flowing, meaning your rent income isn't covering your debt payments, your taxes, your insurance, how long can you sustain that if you don't have a value add opportunity? And so we'll buy properties that are negative leverage, but we're only buying properties that are negative leverage when there's a big value add play, right? When maybe occupancy is low, rents are low, units need to be updated. Okay, well, we know those 3 things. We can come in immediately. We can update the units. We can increase occupancy by renting units out, and we can raise rents that are below market average. We can take that property to a point where its cap rate is higher than what the interest rate is, and it's cash flowing. But if you have a property, let's say 98% occupied, it's at or close to what market rents are, but you buy it where your cap rate is lower than your interest rate, and there's no way to force those rents up, which increases cash flow. There's no way to profit on that property, and eventually, I mean, you're going to be paying, you know, your rent payments aren't going to be covering your costs, and that's not a way to run a business. You'll be out of business. We are always looking for new opportunities, right? We're always looking to, where can we pivot that's going to give us advantage over other people, right? Take COVID, for example, right? Leading up and basically into COVID, even in 21 and early 22, everyone was focused on multifamily, right? We've been focused on multifamily since 2014. But everyone during that time was coming in because interest rates were really low. They could pool their friends' money together. They could go buy something at low interest rates, whatever. That market became very, very crowded. And what you saw, especially during COVID, is that market kind of stopped transacting because of COVID and the shutdowns. And now interest rates have climbed, so that stoppage kind of continued. You saw a huge decline in deal flow by about 90% in multifamily. But what you saw then is a lot of people just kind of sitting back and waiting, right? They're twiddling their thumbs, they're waiting for the market to come back around and correct or whatever to the point they can buy. I don't operate that way. So I'm always looking for opportunities. Okay, where can we pivot? We know this asset class is slow. It's going to be really, really hard to buy and grow in that asset class. Where can we pivot to keep our growth going? That's why we did the Affordable Housing Fund, right? I saw opportunity in affordable housing. I knew it well. And so for me, it's like, okay, well, we're going to pivot over to here while everyone else is kind of waiting for multifamily and focused on that. We're going to pivot over here and keep our growth going. And it's worked really, really well. Take right now, for example, you have a lot of people still focused on multifamily. You have all those newer operators that are still focused on it, but you also have your older operators that have been doing this for a while that are still only looking at multifamily. For us, we're looking at other opportunities, right? So for us, again, it goes back to where can we pivot to if one asset class doesn't allow us to keep growing? Where can we pivot and focus on and put attention to and start building in that asset class? And for us, it's single family build to rent, right? And that's why we opened up our new build to rent fund that we just opened up. Same thing like affordable housing. We see an opportunity, not a lot of people are focused on it. Why do I want to stay in a crowded space and just wait when I can pivot and we can continue to grow where it's less crowded, there's a huge opportunity because the home shortage nationwide is still so large. We're going to pivot and we're going to focus on that opportunity. My opinion for anyone in business, and this just isn't real estate, it's any business at all, is if things become stagnant or stale in one line of business that you're doing or one profit center that you have, you need to be looking elsewhere and seeing, okay, what can I pivot to that has opportunity still that I can continue to grow in. That's a good business person. A bad business person just sits around and waits and hopes the market corrects and comes back in line. And a lot of times that doesn't happen. So other people are going to continue to accelerate ahead of you while you sit there and are hoping and waiting for something to happen that very well might not. So market, environment, dynamics play a role in that for us because, again, if the market dynamics and environment slows one asset class down, I'm always looking to pivot and seeing, okay, well, what other asset class will allow us to keep growing, has big demand and opportunity. I think a lot of people become very comfortable in what they know, and it's very hard for them to push themselves outside of those four walls to learn something new and then start over, in a sense. Because basically you're starting a new business, right? And you're starting a new business in an asset class you don't know. You may know real estate really well when it comes to multifamily, but build to rent is something completely different because you're basically focusing on single family homes where you've known and are really good at multifamily. And it's two completely different things. There's a lot more moving parts when it comes to single family homes. And so if you're not used to that, you can very easily find yourself in over your head. And I think a lot of people get scared of that because they don't know what they don't know, and they're scared to push themselves outside of that box in fear of failure, right? And a lot of times people don't want to take the time to learn what they need to learn in order to move into a new asset class to be successful. And so I think there's a lot of fear there. I think there's a comfortability aspect there. But when you become, for me, the way I look at things is when you become comfortable, that becomes really scary because that means kind of growth is stopped at that point. And I always want to be growing. And I think any business person should want to be growing. So I say this to everyone, real estate's easy. People are hard. People make real estate hard, right? If you look at things as a whole, real estate's really simple when it comes down to it. It's people that make things hard because you're dealing with different dynamics, different personalities, different viewpoints, different, whatever it is. Everyone has a different opinion and view or outlook on things. And so when you have multiple different personalities that you're dealing with, it can be extremely hard to navigate. Contract negotiations are a little bit easier, but you're still dealing a lot of times with emotion because people tie too much emotion to real estate. And I am a very black and white person. It's business for me, right? The number doesn't make sense, it doesn't make sense, and I'll walk away. On the other side of things, you do have people that, depending on what asset we're buying, they might be emotionally attached to it, or it might be a really large number that the other person's attached to as well, right? And so they think their property is worth this, but it's really not, based off of the market environment that we talked about, in the other clip. And so you kind of have to navigate that carefully, I guess, with a touch of finesse, I guess you should say. I'm always not the best at that, to be honest. I'm kind of like a bull in a china shop, and I'm like, look, here's where I'm at. I'm not going any higher. Take it or leave it. Do you want to put it back? You want to go back to market? You want to work out a deal with us? Whatever it is. I've gotten better as I've gotten a little bit older with finessing things when I need to, but I'm still very, very blunt, very, very direct and to the point. That can set some people off the wrong way, right? Some people don't like that. Some people like to be schmoozed and wined and dined, right? And that's not me when it comes to buying or negotiating properties or contracts. I'm very to the point. And so that can cause problems because I'm a no bullshit kind of guy, but it also seems to have worked out fairly well up to this point. Have we lost deals because of that? Probably. Have we gained deals because of that too? Probably. So it probably offsets one another. But people make things hard, especially when you're dealing with multiple partners in a deal, multiple owners in a deal. It can be extremely difficult because you have to get approval from everyone, and then you add the real estate agent in on top of things. If there is one, then you add your loan broker in on top of things if there is one. It's a lot of opinions and a lot of people that you have to all get on board. From the investor side of things, I have found, and this is something that we really kind of pride ourselves on now, especially now moving forward, is communicating a lot and being transparent. Communication can head off a lot of problems, regardless of what it is you're communicating. And so if you're communicating with your investors, the good, the bad, the indifferent, you're going to go a lot further with them. They're going to respect you a lot more. They're not going to, if there is a problem, there's always problems that arise in real estate. If there is a problem and you're communicating with them throughout everything, They're much more likely to be more relaxed about it versus if you're not communicating about things and then all of a sudden the big problem arises and you send out a notification or an update, all of a sudden they're going to be all upset and worried and scared and stuff like that. So communication with investors on a regular basis can head off majority of problems that you have. And so for us, we do monthly updates to all of our investors, and I do it personally via Zoom call with a Q&A session at the end of that call where any investor can ask anything. They also have open access to send us emails or call our investor relations team to talk with them or ask them questions, and if it needs to be escalated to me, they have direct line to me as well. So communication is key when it comes to dealing not just with investors, but really with everyone involved in a deal. Because without that communication, it leaves a lot of things to be assumed or figured out, and that can become extremely, extremely frustrating and annoying, especially when you have, tens of millions of dollars on the line. Like I said in the last clip, real estate's easy, people are hard, right? Tenants, depending on the asset class, can make things extremely, extremely difficult. And so to set yourself up for success, you want to make sure that you have a really good lease that covers a lot of detail. Move in, move out checklists, easy line of communication to property managers. Technology can play a huge part in making sure things are streamlined and smooth with tenants. And I'm not going to get into politics here, but you want to invest in red states because red states are much more advantageous for the landlord, meaning it's easier to evict someone that doesn't pay or causes damage to your property than in a blue state. The red states are much more landlord friendly for that case. And so if you have a tenant that's not paying, or if you have a tenant that's damaging a unit, you want to get them out really, really fast. Because A, they're damaging your unit or they're not paying, which means you're losing revenue on that unit. And so the quicker you can get them out, the quicker you can get that unit turned and a new tenant placed that will pay. And in this game, cash flow is everything. If you don't have cash flow coming from your tenants, you're not able to make your debt payments to your bank on the properties that you have. And so that is a big challenge when it comes to tenants, holding them accountable to the lease that they sign. In essence, they're basically financing their home with us. We're just spreading out their payments over a period of time, right? And so it's very important that they pay and they pay regularly. And we give them the opportunity to do that via online, so it's very streamlined. We prefer that they do. We don't want to take cash. We don't want to take checks. It just adds another layer of issues with it. But technology plays a huge part in making sure that things are done well, you receive payment on time, things are communicated well, maintenance issues are addressed and handled quickly so your tenants are happy and they do continue to pay on time. Maintenance issues and repairs are a whole nother host of problems because you really need to have a budget, and we do have a reserve budget set aside for every unit that we have or every complex that we own. And so you have to really try to stay within that budget so you're not going over, you're not reducing your cash flow, reducing your profits, etc. It's very easy to go through your maintenance budget on a monthly basis if you're just continuing to spend money on stuff, which we've seen a lot of, especially in single family portfolios. You have a lot more maintenance with single family portfolios, and that can reduce your profit per unit because of that. And so sticking with those budgets, making sure that you're being proactive with maintenance as well helps too, meaning you're being proactive with replacing your furnace filters, you're being proactive with cleaning your ducts, things like that, right? You're being proactive with replacing your refrigerator filters. All of those things, if you stay proactive, are going to reduce your expenses in maintenance because you don't have the expense of a maintenance person going out there. You don't have the expense of fixing something that was broken because you weren't taking care of it, stuff like that. Having good maintenance people on staff too really, really helps. And that helps you kind of budget for everything as well. Because, like I said, with single family versus multifamily, single family has much more moving parts, right? For every home, it has its own roof, has its own AC unit, its own furnace, its own hot water tank, which multifamily has some of that, but again, multifamily is under one roof too. So it helps you offset those costs against other units that you are making money on. So all of those things come into play, but making sure that you're really setting a budget, tracking a budget, having reserves in place so you're not blowing through that budget will really help you stay profitable and cash flowing on your properties. Well, so our property management technology as a whole allows us to do a lot. Yes, we can, the biggest thing is we receive payments electronically, right? So we don't have to wait for checks to show up. We don't have to, meet a tenant to pay in cash. A lot of times we don't even take cash. And, that helps a lot. But there's other aspects of that technology piece that comes into play too. And that's like maintenance requests, maintenance requests are done right through that tenant portal as well. The maintenance process is tracked all through there as well. Communication is done all through there as well. So it's really easy to track what's being done for what property and in what stage it's at. Specifically for maintenance, it also tracks your budgets, it tracks your reserves, everything like that for you too. So technology for us plays a huge part, also plays a big part for our tenants as well, to make things as easy as possible. Yeah, so when we're looking to acquire real estate, and this all depends on which asset class, because each asset class has its own strategy and its own process and its own underwriting guidelines that we use. But let's talk about multifamily here specifically, right? There's certain numbers we need to be able to hit for us to be able to, or for it to make sense for us to look or acquire a property. We need to be able to see and expect certain value add opportunities. We need to be able to see and get to a certain stabilized cap rate number, because that will increase the value of that property over time as well. We need to see properties at certain occupancy percentages, depending on which strategy we're using, whether it's stabilized or whether it's value add. And so all of those things go into when we're looking at and underwriting a deal. Does it make sense to buy or does it not make sense to buy? We need to be at a stabilized cap rate right now, around 8%, for it to make sense for us. Because debt right now is going to cost about 6.5% to 7%. We need a little bit of a buffer in there, and then appreciation will take place, in the future. Ideally, once the property is stabilized, we'd like to be able to go in and refinance out of it, assuming rates come down, pull out some of that additional equity that we can then return to our investors. And we need to be looking at areas that have growth opportunity too, right? So we talked about in another clip, when we're looking at different areas and demographics and locations, we need to see steady growth, population growth in those locations. We need to see other comparable complexes that have high occupancy or big demand. We need to be we don't like major metropolitan areas. We like tertiary markets around major metropolitan areas, or secondary markets around major metropolitan areas, just based on the asset classes that we like to buy, which is typically class B with value add, sometimes C+, but we definitely like to focus on B to get it to like a B+, or even convert it to a class A property if we can add the amenities. And so those are all things that we're looking at when we're underwriting, and criteria that we have when we're looking at buying a multifamily property. When it comes to like the build to rent stuff, well, let me go back. When it comes to our affordable housing, we need to be in markets where the housing authority pays a certain dollar amount for a 3-bedroom, a certain dollar amount for a 4-bedroom, and in areas that we can buy properties that fit what our specific buy box is. And everyone should have a buy box when you're looking to buy real estate, especially when it comes to single family. You need to know the price range you need to be in. You need to know exactly how many bedrooms you're looking for. You need to know exactly the locations that you're looking at to make sure that your buy box can be hit. In some locations, we can get the numbers that we need out of the housing authority, but we can't buy properties in the buy box. And so because of that, the numbers don't work. And so everything has to align. The buy box, we have to get properties in our buy box, and then the housing authority rents that they pay need to be at a certain level, so that we make sure that we're cash flowing a certain dollar amount per door to hit our goals that we need to. It's getting tougher and tougher with the way the market is, with where housing values are at, and with what housing authorities are paying. It's getting tougher and tougher to find markets that meet that, but there are still a good handful out there, and that's where we're continuing to grow. Now, when it comes to development and build to rent, it's very similar to the multifamily side of things, where we're looking at secondary or tertiary markets outside of major metropolitan, but you still need to be close and in good location to major arteries to get to where you need to go, whether it's downtown or airport or whatever it is. And it also needs to be good amenities around that location that you're doing build to rent development in, meaning shopping complexes, grocery stores, activities for kids, stuff like that, because that will drive then high demand to rent those properties, because all that stuff is close by. And then we also need to look at what's it going to cost to develop each property, in this development that we're building, and what can we get rent-wise out of each one of those houses, and do the numbers line up to make sense for us to be able to profit, get a return back to our investors, and cash flow on it as well.